What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
Hi, everyone. I'm Harry Melandri, and welcome to Real Vision. With me today is Michael Powell, CEO of Akanthos Capital Management and co-host of the podcast Chaos Theory. Michael, good to be with you again.
It's great to be with you. Yeah, it's been a while. Glad to be back.
So I took a look at your recent output before this, because like minimum due diligence and all that. And you were kind enough to let me pick anything you've recently looked at to discuss. So I'm going to try and take advantage of that and chat a little bit about geopolitics further down in the call, because like I know that the subject's pretty much useless for any short-term trading, but it always fascinates me. And I always want to hear where others are on some of the key questions. But before we go there, can I touch on your Fed views? The phrase you used was, did the Fed pivot too soon? I'm impressed that you managed to avoid using the word premature. Has terrible.
Oh, I didn't. I did use premature.
That's right. You did.
Not only did I use premature, I called it pusillanimous Powell's premature pivot.
I took
as I'm a fan of alliteration.
I took a note of the pusillanimous. And you know, I was with you. I looked at that. I was surprised. Most of the economic commentators were surprised. Right, the economists didn't see it coming, which tells you something. And I'm wondering where are we wrong on the Fed's reaction function? What should we assume about how the Fed is thinking about the economy?
You want to unfuck your shit? This
is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there. And let's help you unfuck your future.
I think I go back to a piece that I wrote many, many months ago. I call it the four horsemen of U.S. economic resilience, right? And I talked about how, you know, there are a number of drivers that are making the U.S. economy stronger than the rest of the world, and that presents a problem for the Fed. And real briefly, those four horsemen are: one, there are certain demographic and structural factors behind the stickiness of labor and housing inflation. Two, and probably the most important, is the fiscal impetus here, unmatched by any other country. Three is that both our consumers and our corporations are relatively rate insensitive, and part of the macro confusion that people have been picking out of the macro data comes from the fact that there's a little bit of something for everybody in the data. If you want to look at what fits your narrative, a predetermined narrative. So if you're thinking that the Fed's too late and we're going into a recession, well, guess what? You can find the data in those segments of the macroeconomy that justify those points. But my point is that if you look at the bigger aggregates, whether it's, you know, credit spreads, credit availability, just the overall GDP growth, unemployment, at a macro level, you are just not seeing the cracks to justify a cut now. And then the fourth and final is we have relative energy independence. But I also think that that's been a little bit mooted because given I've had this short-term bearish view on oil for some time, and we can go into that if you want. But anyways, so those are my four horsemen of the U.S. economic resilience, and then that pusillanimous Powell piece that I referenced that I wrote I think 2 months ago, which was a little controversial at the time, but I feel somewhat vindicated in that call that the Fed was premature because you start to look at some of the last jobs numbers notwithstanding, which was like a big a positive surprise. But one thing that I pointed out 2 days ago is that the 5-year inflation swaps have been just roofing, and you're seeing certain commodities, like gold, et cetera, react accordingly. You're seeing the bond market, which I also predicted in that pusillanimous Powell piece, that if the bond market senses that the Fed is no longer up to its job to containing inflation, and I did this whole research on like the 1980 to 81 analog, where a similar thing happened, that you would see the long end essentially rebel, and we've seen that happen. So I think the Fed screwed up here. So we'll see. I mean, at a very, very macro level, to just show you, I mean, to me, this seemed pretty obvious, but I'm looking at a dashboard, a world economic dashboard that Koifin updates basically on a real-time basis. And if you look at the top several economies of the world, right, you've got the United States with GDP quarter on quarter around 3%, CPI around 2.4%, and you've got hang on a second, I don't think they have unemployment on here. Yeah, okay, so job unemployment rate, call it, for some reason they have 4.1% on here. That's totally not right. Anyways, it's a little bit higher than that even. But and then if you look at the Eurozone, the GDP compared to the US is 3% quarter on quarter. It's like 20 basis points. CPI there is like 1.8%. Okay. Jobless rate is 6.4%. Yeah. You look at China, GDP quarter on quarter, it says 70 bips. And then CPI is like 0.4, although I've seen measures that are showing actually deflation in China. And then the jobless rate there, I don't believe this for a second. It says 5.3%. When you look at the youth unemployment in China, it's like in the mid 20s to maybe even above 30%. And then
is that all youth or graduate youth?
That I have to look into. The last country though is Japan, right? So Japan GDP quarter on quarter 70 bips, GDP year over year negative 100 bips, CPI at 3%, and there the jobless rate is lower, right? But my point though is that when you look at the macro aggregate data, there simply was no reason for the Fed to react in the way in which it did, especially with 50. And that's the part that was a little bit shocking to me. So I'm currently short the December 25 SOFR futures because I still think that it's currently implying Fed funds of around like 3.5%, right? By end of 25. I think it's going to be much higher than that.
I'm long of that contract, so we're going to have a sparkling debate. I'm long of it via calls. And the reason I'm long of DEC 25s, it's connected to the same reason you're short of it. My suspicion is we got some kind of policy mistake here, but I don't know what's motivating it because nothing I see could kind of explain the decision on a purely economic basis, which I think is the same conclusion you reached.
So why are you long of it?
So I think it pivots around fiscal policy in 2025. I think everything will boil down to my suspicion is that they all know this. So everybody involved in policymaking knows this already. But that for, let's call it political reasons, there are really good reasons to goose this economy here and now, at the margin, run it a little hot. Well, I had this discussion with a friend of mine, and they accused me of being a conspiracy theorist. Of course, they're right. I am a conspiracy theorist. But that doesn't mean I'm not occasionally correct in my analysis. So what I'm thinking is that we shouldn't think of it as a bigger, broader, like nonsense decision. We should think of it at the margin. And if you're a Fed official who perhaps is getting irate phone calls from the White House, if it was a question of doing 25 or doing 50 to start, you might well start with a 50.
Well, that's that. My only rationalization for why Powell did 50, and the minutes showed that he seemed to have strong-armed folks into the 50.
Yeah,
I have I'm disappointed in him because of all the Fed chairs we've had recently. I felt that he was probably less likely to be political, but I do think that this decision may have been somewhat political in that. If Trump wins in a couple of weeks, I think he will have a harder time. I think he wants Kamala to win, given the issues, given the threats that Trump has foisted on him in the past. And I feel like he jumped the gun here to basically sneak in that extra cut early on in case that maybe the data don't justify it later. I don't know. It's hard.
I think that's exactly it.
It's really hard to kind of figure out what's in his head. But I was a little bit surprised that he did 50 initially. But I do think that because he did 50, and especially that in that presser, he was extremely dovish, and the markets priced in unreasonable. What I think are an unreasonable set of cuts given the macro circumstances. So we'll see.
Yeah, I think that's exactly right. That we shouldn't extrapolate from that 50 directly, but you're tempted to because you can't really reverse engineer it. So you have to adjust your reaction function to some degree. But it's probably a mistake. It's probably done just as a prophylactic. Because you don't know if you can deliver data.
The yield curve is telling you it's a mistake, and so are inflation swaps.
I was reading a friend of mine's piece. A friend's a Fed watcher, right? Talk about a weird job to have, but he's been a Fed watcher since 2001 or before. I've known him since then, and he used the word Yankee or janky with regard to data. And it got me thinking because they were already thinking there were some weird seasonal effects in the unemployment data, that it was seasonally boosted, so higher than it really is, and in fact the labor market's weaker. Yeah, they can always have it. But with the hurricanes we've just seen in Florida, right, that jankiness of data is just going to persist.
There's going to be more noise, but again, on a big picture level, right? What are we measuring against? Because, even if it's 4.5%, let's say, okay, we're measuring against an all-time tight of around 3.6. And when you have GDP as strong as it is, with certain measures of core inflation and super core still basically around 4.5 to 5%. What are we doing? Because when you think about this, I've been calling this economy we've been having this vodka Red Bull economy, where you've got this monetary depressant offsetting this fiscal Red Bull. And what Powell has done is he's removed that monetary depressant, or at least started us on the path of an aggressive removal of that monetary depressant, which leaves you with a lot of Red Bull. And one of the other points that I don't really see most people address that I wrote in that pusillanimous Powell piece is that there are a number of supply inelasticities here. One or two of them alone isn't a big deal, but the confluence of all of them, I think, is a big deal. And so, as you know, when you've got a inelastic supply curve, the last thing that you want is something that stimulates that aggregate demand curve to right shift, because a little bit goes a long ways when you've got a supply inelastic situation. And so, real briefly, the supply inelasticities that I talked about were let me find it.
Well, one of them is housing, right?
One of them is housing. One of them is oil, which is artificial, driven by geopolitics and Saudi's unilateral cuts. You've got freight rates driven by geopolitical risk in the Middle East. You've got manufacturing capacity, again, driven by geopolitical choice of nearshoring. You've got something technical, bonds, right, driven by Treasury's deliberate QRA games to restrict duration supply. You've got housing, which we talked about, and then you've got labor. This labor, I believe, the spate of strikes that we have seen over the last 2 years, that doesn't happen when you've got fundamental labor slack. Labor has had abnormally high leverage. And I think that's a result of demographic undersupply in certain cohorts. If you look at the demographic pyramid of the United States, and I've pointed this out in past tweets, the age cohort between, say, 45 and 59 is a relative trough. That is the Gen X cohort. That's my cohort. That's the cohort that came after the baby boomers. It was a relative trough. And that cohort also happens to be the most highly tenured part of the workforce. And I think because it's a relative trough, I think that's driving some of this labor stickiness. So anyway, I think the confluence of these like 6 different supply inelasticities is going to shock the Fed, where even a little bit of a right shift in aggregate demand is going to, I think, reignite inflation. So
I used to do a bit of Fed watching myself, used to be a real money manager for a while. And what I found recently is when I chat to people I know who are still in contact with Fed officials, that everything you think is going to shock them, they know. Right? As a general rule, if you say to them, why are you doing this? Don't you realize X or the inelastics? They will say, yeah, no, we get that. And then you say, so why? And they'll say, politically, we can't address it right now. This is not the moment. This is not the time. Can't do it right now. Can't do it from here. Congressional problem. You'll hear things like, it's in fact, shockingly, sometimes I think to myself, oh, the Fed are Marxists now. They're quoting back Marxist dialectic to me on certain issues. It's that you get really weird effects. I saw you wrote something about what the current situation is not as simple as a K-shape economy, as more nuanced. And I took a note. You said something like within the US, we have. I generalized it because I think what you were saying is you've got winners and losers, but actually you've got those with market power and those without. And if
I'll address that. I mean, I call it this bifurcated economy, both, but I parse between the consumer and the corporate, right? Because the K-shaped recovery typically refers to you've got your richest deciles and your poorest deciles, and I guess right. you could generalize from that perspective, at least on the consumer front, but it's a little bit more nuanced than that, because there's the matter of who has the leverage in the economy, both on the consumer and on the corporate side of things. Because on the consumer side of things, there obviously there is this bifurcation between rich and poor, but there are certain wealthy people that are hurting because they are in sectors that are very levered, like CRE, like office CRE,
New York CRE.
Correct. That's right. Okay. There, and then on the corporate side of things, right there, it's the same thing where you've got to your point about pricing power, you've got the Mag 7, the big companies that are flush with cash, and having a high Fed funds rate actually helps them, right? However, you've got a myriad of companies that also have floating rate debt. Generally smaller cap sub-investment grade companies where their cost of money just went from SOFR plus 500, essentially SOFR used to be zero. So that used to be 5% money. Now it's 10% money. Mm-hmm. And that's killing that segment of the economy. But again, because the big and the rich dominate the macro, right? On a macro basis, you are not seeing stress. You're just not seeing the stress.
It's not quite
in
an
credit
80,
markets.
Yeah, it's not quite an 80-20 rule, but it's something like a 60-40 rule. That 60% of the consumption is done by roughly 20% of the population, something like that.
And there's one more point here I want to make because I think it's an important one. There was I responded to somebody's tweet a couple of months ago about showing the spike in credit card delinquencies as a sign that the Fed is too late. The low-end consumer needs relief now. And I said, you actually got this all wrong. The low-end consumer that actually incurs 20+% interest on credit cards, they're doing that because they are living hand to mouth and they are getting creamed by the most regressive tax of all, which is inflation. It is inflation that's killing them. If inflation weren't a problem, they probably wouldn't be needing to incur and pay and have rack up huge credit card debts and paying 20+%. So I think that is a stark example of where like there's certain data, and if you just think on a first order basis, oh yeah, lowering interest payments will help that consumer. Well, okay, you're going to lower interest payments 2% from 21% to 19%. That's going to help that consumer. But meanwhile, if inflation reignites its head, what happens then?
The example that really caught my imagination and really clarified it for me was the longshoreman. Smart cookies. That Harold, whatever his name, he totally got that this was the time to strike because the administration would lean on his opposite numbers. They have market power.
That's right. But again, that doesn't happen if you have labor slack.
Absolutely.
And do you know what I'm saying? And
absolutely.
So, and it's not just the longshoremen; it's multiple industries across multiple sectors. So that's why I wanted to think a little bit deeper and say, okay, what is the commonality here? The commonality, I think, is demographics. I think it's something deeper that is giving labor that type of leverage, and it's just one of multiple supply inelasticities that I can think of.
Yeah, I can see. I take that point completely. I think there's another aspect, a mechanistic aspect to this that we should look at, which is when you're creating an average like the CPI index, you're going to have some components which are strong and some components which are weak. The problem in an environment where you have these inelasticities is the strong components are going to be very strong. It's going to be really hard to stop the longshoremen scoring themselves a 60% pay increase because they have so much market power. And in order for that to offset, you'd need to see someone get what kind of reduction in wages. Well, so here in the Accelera corridor, rents are tight, right? There's very little spare housing stock. And that's going to be because a lot of the defense industry is up and down here, and that stuff isn't slowing down. That bias on inflation is so strong that I think we're going to have this rather unpleasant combination where even if the economy slows, CPI index ain't coming down that much.
No. In my Pusillanimous Powell piece, I wrote that the component of the particular inflation component that I'm most concerned about is the housing inflation, because that structural undersupply doesn't get solved overnight. And with these sort of clownish proposals of helping with $25,000 mortgage assistance down payments.
It was funny.
Right?
Yeah.
I mean, it's just like completely. Are you kidding me? Like you're going to. That's what perpetuates a vicious cycle, right? It's that kind of thinking, and so that's a big concern because here, look, I live in LA, right? And my kids are just entering the workforce, and when you look at the rents that they need to pay for like a safe building out here, it's almost impossible for a young person, unless you're in certain super highly paid industries, to be able to afford the cost of living right now. And I really worry about my kids' generation because what used to be, and then that's just rent. But if you talk about,
we had a tailwind. We had a tailwind. They have a headwind. It's
huge headwind.
Yeah. So let's get to the bottom line on this discussion. There's a lot of common ground, but let's look into 2025. So what is the trade? Where do you see this end game? Where do you see this interest rate? Where interest rates pan out? I told you I bought some calls on 2025. So for Deck 25.
Well, I still don't really understand your thesis there. Well, you think that the Fed is, despite our common ground on the inflationary aspects of it, you are betting that that Fed funds is going to be lower.
It might end up at zero, and that's so.
Yeah, I don't see that at
the
all.
logic of that is, I think that the official sector sees a fiscal problem, a serious fiscal problem that they would like to address, but they've deferred addressing it till post-elections, because addressing the fiscal problem will be extremely painful, extremely contentious. And so all of this whole question of the appropriate level of US fiscal spending has been deferred for after the election. If it's a Trump win, it will be addressed in a certain way. If it's a Harris win, it will be addressed in maybe a different way. But the impression I get is that it's post-election the officials will turn their attention to the appropriate level of the deficit. And whatever way you cut it, it's going to be much lower.
So you think that the fiscal Red Bull gets withdrawn, and therefore the monetary depressant can be completely withdrawn?
I think if they don't do something about the monetary side, those weak interest rate sensitive sectors of the economy will absolutely collapse. So what you'd need is, as they pull back on the fiscal, the Fed will probably have to be very aggressive. And the reason I like that bet is it's really hard to get a geared bet on zero rates. I'm not saying it's my central tendency. It's my most central scenario, most likely outcome. But I think I'm being paid good odds on options.
Interesting.
To take that bet. Like it's 21 or 22 cents for a particular strike. And I don't want to forgive everyone listening to this. You be careful playing with options, right? Don't be messing with options. Definitely do not sell them. So don't consider this a trade recommendation. But I like this as a tail bet for what could happen post-election. I've got a weird sense that everything's being held together until we get through the elections, and then après ça, le déluge, so to speak.
The thing is, though, I mean, this is why I love talking to smart people that have different opinions than mine. I respect that. I don't agree with it, just because I feel like both candidates are profligate spenders. Now, here's the thing. The CBO came out with a whole bunch of their predictions, and I don't know what their track record is in predicting this stuff. Talking about, for instance, like a Trump administration being far more inflationary, far bigger deficit. I actually would take the under on the Trump win in terms of the fiscal profligacy, because I think what people are potentially discounting is that if he comes out with tax cuts that are not offset by spending cuts, and especially what I'm particularly interested in is if he assigns Elon Musk this idea of cutting government agencies, and seeing what he did at Twitter X, that's a sort of a once in a generation opportunity to actually cut back on government. Now, we'll see whether that can actually happen. So I'm with you from that perspective, that I think that some of these huge predictions on deficits exploding. I was just mentioning today to some friends that, if we wind up having sort of a Liz Truss moment in bonds because of that, I think it would be a fading opportunity personally. But we'll see. There's too many. I don't like to make those types of bets where there are just too many contingent probabilities that need to happen. Right? It's a little too hard for me right now to make that kind of bet.
Yeah, it really is a binary, because it's either X or Y. But I think so to address the several points you made. Number one, so Trump is Trump. I have no idea what she's really thinking on policy, but I assume she'll be continuity to a great degree. But I talk to guys from Political Alpha that do a lot of very focused work on what's happening in DC, and their surprising message is that the transition team for Trump are very focused on the deficit, and that Republicans, the kind of core constituency of Republican reps, are very concerned about deficit trends and would like to do something about it. So the sense I'm getting, and you get that from Fed officials as well, everyone's giving you, let me put it another way, even someone as dumb as me, can see that the projections for US deficit spending are non-sustainable. It really can't continue. So that if something can't continue, it will eventually stop. Stein's law. When does it stop? And I'm thinking that 2025 is when that comes to a head. Now, I can be wrong, and then I write off 20 basis points, 20 cents of option premium on those things. But I think, I suspect that is when it happens. With regard to the Harris guys, well, everybody is talking about the deficit. You asked about the CBO's track record. Terrible. Consistently terrible. Why?
That's what I figured.
Because they tell government what they want to hear. Right, but CBO is, if you read between the lines in that document, it's a ridiculously big document, by the way, folks. Don't read that document. Honestly, it's not going to improve the quality of your life. If you read between the lines on it,
it's a very politicized document.
Yeah, but reading between lines, it's worse. Right, it's worse than it shows. Everything's worse because all the assumptions are on the positive side of things, or the rosy side of things. So I do think that we're going to turn our attention to that. And if we don't, well, we're going to inflate at a shockingly quick rate, which is why I wanted to cover one end of that tail risk, because the other end will actually look after itself. Like so many American corporations, I got 30-year fixed on my liabilities. So if we go the other way, fine. But I'm just not betting on the moderate center.
Yeah, I mean, you're certainly betting on a tail. I happen to think that that's a very, very low probability tail. I personally don't see us going back to ZIRP for a long, long time because of these structural supply inelasticities. I don't have that much faith that the deficits are going to be reined in at least all that quickly. And as a result, I think that my predilection is that you need that monetary depressant to offset that that Red Bull. Otherwise, we are going to have a very difficult time with inflation. So, yeah.
I really hope you're right, because that particular end of the distribution doesn't hurt. The thing that might hurt my financial interests is having to go back to ZERP. So that's why.
The thing with ZERP is that I feel like ZERP policy, right? I feel like that whole honeymoon with ZERP is a honeymoon, because when you look at the much longer arc of history, that was a very, very unusual period. And I think that, and to think that we will go back to ZERP, I think that tends to be recency bias focused on that honeymoon period. I think that the last several Fed chairs that we've had, especially this one, and the reason why I call him pusillanimous is that at first it was okay. There was tremendous Fed response to forestalling a second Great Depression during the GFC. Okay, I get it, right? Success, great. But now there is a predilection at the Fed to eradicate all semblance of business cycles. We can't even have a slight labor slowdown, much less a recession.
I see that, yeah.
God forbid a recession. Well, guess what? What actually cured the inflation of the 80s was a good old-fashioned recession.
Sure.
And this is where I feel like the Fed's dual mandate. I've been writing that I don't feel like the Fed's dual mandate should be in conflict yet. They should still be focused on the inflation mandate. But given the last presser, it feels like now they've completely focused. They've written off inflation, which is why I call it team transitory redux. And they're now focused on the unemployment side of things, even though, again, we're 70 bips off an all-time low.
I know. And some part of me, one of the conspiracy theories I play with, so you mentioned Bernanke. I think Bernanke is a wonderful example of this. Do you remember he was at Princeton and he was not the most prominent Princeton economist in 2002? That would be Woodford, right? Somewhere out of nowhere, somebody suggests Ben Bernanke to become a Fed governor. And I remember going to see him, I think 2005, to discuss real estate price. And I remember saying something stupid like, isn't it obvious it's a bubble? That's a great way to end a meeting quite quickly. But the point being, why was Ben Bernanke, not Woodford, the guy who was selected to sit in that chair? Is it anything to do with the fact that he was the guy who did a dissertation on the Great Depression and the Fed's failure to expand its balance sheet as a solution to the Great Depression? So someone suggested to me that wasn't an accident. But he was selected precisely because of that.
I don't know. I don't put that much prescience in whoever who appointed Bernanke. Was that Bush? I can't remember now.
It would have been Bush, wouldn't it? And there's got to be somebody on the Bush economic team recommended him.
I don't ascribe that kind of prescience because it just so happens that he was appointed because of his background, his particular background, and that would say that the appointer foresaw the GFC coming and that we needed somebody of his. I think Bernanke gets a bad rap in many cases because he sort of opened the Pandora's box of QE. But that said, I will say that I think that we had the right Fed president at the right time, because the GFC was a situation in which the very financial fabric was being threatened, where even good companies and good banks were being dragged into this sort of perception becoming reality type of vicious circle. So it needed to be arrested. But I think the mutation of Bernanke's Fed policies is unfortunate, because that mutation is what I refer to as this complete intolerance of any business cyclicality anymore, which is not healthy, because it zombifies shitty companies and keeps them afloat when you need a Chapter 11 process to clean out the corporate rot.
I agree. Julian, one of my colleagues at MI2, tells an anecdote about how he met Robert Hernig at a conference, and he went across to complain to him about QE. And Hernig said, "Oh, it's all that Bernanke's fault." He opened the doors to this nonsense, and it's true. I don't know. I recognize also that the Japanese were QEing a long time before we were, and they didn't have much of a choice in the matter. Once again, sometimes to hold, you're gonna have a choice between the financial and your financial sector's integrity and maintaining monetary policy's integrity. And, it seems to me that when that choice comes, we're probably going to choose to maintain the financial sector's integrity again. So, because we always every time we've had that choice in the past, we chosen that direction. Can I drag you on to Geopol?
Please.
Geopol. So,
I love it.
I'm an idiot. I bought Alibaba, and you might say, what was the kind of investment thesis there? And part of the investment thesis is that Chinese stocks have repriced down a long way. That doesn't make anything bullish, right? Just because it's cheap, it don't make it good. Nope. But there's a lot of sin in the price of Chinese stocks. And I look at China and I see an enormous deflationary disaster. But that real estate market could not possibly get off that belly. It's way overconstructed. No. It could be the biggest real estate overbuild of all time, the biggest malinvestment of all time.
It dwarfs, I think the magnitude of the crisis really dwarfs what we saw during GFC. It just dwarfs it.
It could be like my estimate is like 4 to 8 times, which isn't very helpful because, a factor of 2 out, but it's huge.
I wrote yesterday, I think that I said, outside of a debt jubilee for the masses, I see no way out for them, because it is just the Chinese economy is just way too historically dependent on real estate. My good friend Alex Stahel is about to release a huge tome of a PowerPoint that I've been helping him proofread. It's all on China. It's a 200-page deep dive on China, and it was some very eye-opening stuff. Did you know that the Chinese mortgage system, right? Our mortgage system is predicated upon, you take out a mortgage on a finished asset and it's recourse to that asset. Okay. That's what we know, right? The Chinese mortgage system has somehow mutated into something where the mortgages were taken out on pre-sales on product that at this point, because they are so overbuilt, there are estimates that there are enough empty buildings there to fill potentially 800 million to 1 billion people. Okay, so even if these pre-sales wind up getting built, they'll be empty, right? So to make matters worse, the mortgages are recourse to the mortgagee's balance sheet, the rest of their net worth. So can you imagine the enormity of the reverse wealth effect? It's unimaginable. The other thing is that I think the LGFVs are essentially all insolvent there at this point, but they're not really allowed to mark their assets down. And so I think that there is a huge, the whole PBOC balance sheet, I think, and I even wrote about this last March during the Silicon Valley crisis, banking crisis. I actually wrote this piece called Ball in a China Shop, saying the real deflationary threat to the world, it's not Silicon Valley Bank, it's actually China ultimately imploding. And I feel like we are getting closer and closer to, again, I'll use the alliteration, a discontinuous denouement in China, where one way that I've been playing it for the last year is I'm still long U.S. dollar CNH. I think that China. Let's put it this way: when Powell embarked on his aggressive easing and the yuan briefly strengthened to slightly below 7, I saw all these rationalizations for why, China's going to revalue its yuan. China's got this big trade surplus, blah, 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 blah. And I said, I don't buy it at all. I think China needs a strong yuan, like it needs an ice pick in its skull. I think a discontinuous devaluation is still very, very much in the cards because they have a huge debt problem. Ultimately, everything is going to get consolidated on the PBOC's balance sheet. And then the other point that I want to make here, and this is where I break with the Michael Pettises of the world, is they claim that China, being running the world's largest trade surplus, frankly, doesn't care about its currency. In fact, they maybe could want a stronger yuan because they just don't care about export competitiveness. And I completely disagree with that because I think that while that rationale might make sense from a Western economic perspective, you simply cannot evaluate China, the CCP's policies through a Western economic rationale. Because to me, Xi is cut from the same ideological cloth as Mao. And he only cares about one thing. He cares about staying in power. And how do you stay in power when the last several decades, the urbanization that has been driving China's economy has all been predicated upon real estate. And now real estate, they simply cannot reinflate that bubble. They won't, as Three Red Lines shows. So now I call it, the CCP's eye of Sauron has turned from the real estate sector to what I call its runaway assembly line, its industrial capacity, especially green tech industrial policy, where I think of that funny scene with I Love Lucy, where Lucy and her friend are working on some assembly line, but it's churning out goods. It's churning out goods faster than they can package. That's China's runaway assembly line, and it doesn't matter that whether it's running at a loss or not. It matters that it keeps running and the goods keep selling because that's the only way for them to keep the rest of masses gainfully employed. And therefore, I think that export competitiveness still matters at the end of the day. We currently, the U.S., by the way, charges a 100% tariff on BYD EVs, I believe, right? And I think the EU is 50% or something like that. I think the day will come where the entire world needs to erect 100% tariffs on almost every Chinese good because of this runaway assembly line. And China's last bastion of defense there is a discontinuous devaluation of the yuan because it kills multiple birds with one stone. It helps them with their structural debt situation, and it maintains that export competitiveness in the face of rising protectionism. So
you made so many points, and there was a couple I wanted to push back on.
Sure.
The funny thing about it was, in all your conclusions, we agree. It's some of your kind of lead-ins to those conclusions we disagree. So, for example, you made the point about recourse lending. Yeah, I'm sure you're right about China. And the reason I know that is I read your piece earlier because every now and then I do my homework. Not very often, but every now and then. So yeah, I did know that. However, US real estate loans for little guys are all recourse. as well. So you default on your mortgage, they can come after you for the balance. They often don't bother, because why would you bother pursuing somebody for a balance you're pretty damn sure they haven't got, right? It's just legal fees, doesn't do anything. But I own real estate. I'm on the hook for it. It's a recourse loan. Obviously, I'm not rich enough. Otherwise, if I was rich enough, I wouldn't have recourse loans. When you get rich enough, you don't do recourse, right? It's because that's one of the perks of membership. I agree with you completely. On the out of control assembly line and the geopol, I think it's a little crude to say they only care about staying in power, but it's true that with regard to any political authority, the first rule is you have to stay in power, otherwise you have no authority.
Well, why do you push back on that? Because I challenge you on that. Because when you look at their economic policies, especially the zero COVID policies, right? Do you think any of that was rooted in economic rationale? Or for that matter, I would say that even when you look when you read between the lines and you look at its recent stimulus measures, right? I called it's kind of like putting lipstick on a pig. They have all these things that basically helped your Baba stock, right? And encouraged sort of margin buying of equity, but none of those measures do anything to really help the real economy and solve the real problems. So to me, so go ahead.
I would struggle to solve their problems as well. Those are difficult problems. The only point I was making before was that staying in power isn't the only objective of the CP. It is a priority, because if you're not in power, you're gone, right? But I guess things haven't really changed that much from, say, 2,000 years ago when China first unified. Whoever the emperor is, they have domestic concerns and international concerns. And so in this particular case, the emperor is a communist emperor. He has his domestic concerns, ensuring social stability. And you're right. The only way to do that is keep people employed.
But I would make Deng Xiaoping was a communist emperor too, but a very different one than Mao, and very different than Xi. Yeah.
It could have been just the environment was different and they had different challenges. I'm not sure. But the conclusion,
I would disagree with that. Yeah.
I don't want to stick on the ideology. I want to go. The conclusion is interesting. We kind of agree. They have to keep China fully employed, and they're doing that against a backdrop of their partner economies saying, you have excess productive capacity. We don't want your exports. And doesn't that give China deflation and us inflation? We could buy cheaper electric vehicles from the Chinese, but we reject them and pay more for domestically produced EVs.
That's right. I mean, I think that China, if it weren't for this, the geopolitical aspect of things, I would say that China's ability to export its deflation is frankly the Fed's and other central banks' best friend in terms of fighting inflation, right? But as we all know, I think geopolitics do play a part, and I think that it does sort of call into question whether or not we should even be that protectionist, because frankly, the U.S. is 2 years ago, I co-wrote and co-presented this paper at West Point, and the title of the paper was "U.S. Dollar Primacy in an Era of Economic Warfare," and we talked about a lot of different things. But one of the things we pointed out is that the U.S. the U.S. is the least export dependent nation of the top, call it the G4, G5, right? But that's not going to stop politicians from using that as a rallying point to protect, whatever manufacturing capacity is that they want to protect, right? So I think that whether we agree with it or not, that geopolitical protectionist element is here to stay, especially because of this runaway assembly line dynamic. And again, I think China can deal with a stronger yuan for a brief period of time, but especially with these protectionist measures rising, I think the impetus to keep people employed and keep that runaway assembly line running is going to dominate. And I think that's one of the reasons why I'm just structurally bearish the yuan. I think they have huge problems.
Yeah. And I'm bullish the certain stocks. If the underlying business has value, and I'm not a good equity analyst, so I could be completely wrong about whether Baba or any other Chinese stock has value. If the underlying business has value, the policy environment for the Chinese stock market is gonna be highly accommodative because of those enormous headwinds.
See, this is where I'm going to push back also, because I think that what is a stock? It is the present value of discounted cash flows. And you have to believe that you will ultimately get some measure of dividends or of those cash flows. I just don't trust the Chinese framework. I think it's great. You could speculate in Chinese equities, but I'll repeat to you an anecdote I repeated that I told you in our pre-interview. The last time I invested in China was in 2012. When I was still running my fund, and I did a lot of convertible and capital structure arbitrage. I was involved in a convertible in a company called Suntech Power. Suntech Power was one of the sort of higher quality, legit solar companies. The founder, I forget his name, owned a ton of stock. The balance sheet was pretty pristine. The converts were the only debt on the balance sheet. One day, I was short stock against the converts. One day, I get a headline comes across. Our Portuguese subsidiary somehow absconded with 400 million of treasury cash. We're going to do our best efforts to recover this cash. Dude, my bonds, I can count on one hand the number of situations where I've had bonds go down into single digits. I think I can only count on one finger the amount of times where my bonds went to zero.
Yeah.
That was the last time I invested in China. I'm like, all right, nope. I won't do it.
I'm a veteran EM investor. And fraud is going to give you a donut every time.
But see, here's the thing that you could say that that's idiosyncratic fraud. But I think that if you look at the entire way that the Chinese economy has been financed, I think the entire economy is based upon a Ponzi. So
I think you make a fine point. It's kind of true. I'd argue the same kind of is a little bit less true, but not so distant from where the US is because of the flow of funds analysis. There's a flow of funds analysis analogy between how China's financed and how the US is financed right now. The government sector is enormous. And if that flow from the government sector into the rest of the economy switches off, everything's zero. It's a real problem. But I kind of assume that won't happen. And perhaps I'm being overly optimistic on that. Let me ask you one last question because it's really running out of time. So I spend a lot of time staring at the Ukraine-Russia war, partly because I'm got enough to do, partly because there's one question that really bothers me. So why does it matter? Does it matter who wins? And if it does matter who wins, why? What's the importance of this war? What do we care about here? Is there an economic effect? Do we have a trade?
You're gonna force me into saying something kind of controversial, but I think that geopolitically, Ukraine is not as important to the US as some other hotspots. I'm most concerned about the threat of China and the Indo-Pacific to the US from a pure, geopolitical perspective. And of course, there's also the instability in the Middle East. I think that, I've been saying for a while now, this is somewhat of a segue on something a point I wanted to make. I've been saying for a while now that the true geopolitical risk to oil is to the downside, especially in a Trump win. So let me explain. I think I've been saying for a while, ever since Saudi Arabia unilaterally cut supply to support to keep sort of the oil floor around $90 for a while. I've been saying that was a mistake because they were doing it at a time where they were fighting the Fed, right? And now you're seeing the chickens come home to roost because their tool, like the Fed's tool, is a blunt instrument and is demand restrictive. However, their tool has a further perverse effect of keeping the Fed more vigilant because of the inflationary components of it. So now you've got Saudi Arabia in a position where they don't really have an exit strategy from their cuts, and the folks who have been benefiting from their largesse are Russia. So I'm coming back to your Russia-Ukraine question. Russia and Iran and the UAE. They have been the biggest cheaters during this whole process. So if I were on the Trump transition team, right, and he wins, what I would actually be advising is that, okay, you give Saudi Arabia something it really wants, like a security guarantee, right? That's from the US. Make it explicit. But in return, you ask them to basically come back online and bring those 3 million barrels per day back online. You score a huge political win at home by taking oil down to 50 and getting at least solving one supply inelasticity, right? But you also kill two geopolitical birds at the same time. You wind up defanging Iran and Russia. I actually think that low oil prices will be what brings Russia-Ukraine that war to a close. Because if you defang the Russian economy, I mean, how stupid is it that over the last 2.5 years, okay, despite all the bluster and price caps and sanctions on Russia, what is the number of Russian barrels that have actually been disrupted? It's 0. And that was by design, right? Because oil is too important of a global commodity, right?
Sure.
And that's why I've actually also been betting against. I faded this geopolitical spike with all this bluster about Israel wanting to attack the oil infrastructure of Iran. And over the weekend, when I saw that the U.S. was going to deploy its THAAD missile system to Israel, I said, that is the tell. That is the tell right there that no oil infrastructure will be touched.
That's right. That's a quid for the pro.
That is absolutely right. That is absolutely right. So but I think though that the real geopolitical downside to oil, geopolitical risk to oil is actually to the downside, especially if Trump wins. So we'll see. We'll know soon enough.
Michael, I've overshot time. It's my fault. I was just too keen to talk geopol, same as usual. Thank you so much for sharing views and jousting a little bit with me.
I love it. You know what? You're a smart guy, and I really respect differing points of view, and we'll see. I would be shocked though that if we go back to ZERP in the foreseeable future. But
I think of it as like a 20% probability that's priced to the 1% probability. That's kind of my thinking. But you know what? I'm going to record you saying I'm a smart guy and play it back to my wife because she does not agree with you. Anyway,
awesome.
Until the next time, thank you so much, Michael.
Awesome. Thank you.
What if you could invest in a hard asset like silver and then earn a return in that same asset, bypassing the fiat dollar system entirely? Now you can. Monetary Metals has made a name for itself by generating a yield on gold and silver for their clients over the past 8 years and counting. Now they're offering the first silver bond in almost 200 years with a 12% annual interest rate paid in physical ounces of silver. Available to accredited investors only, investors in the bond receive a fixed 12% coupon on silver paid in physical ounces of silver, plus any silver price appreciation. Over half the bond has already been sold, and the remaining allocations are going fast. Do not miss being a part of this historic offering. Protect and grow your wealth in an asset that has stood the test of time. Secure your spot at realvision.com/metals.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.